Will the market take a June vacation? Let's find out. Hello, my friends. Welcome to another monthly market commentary video from IronGate Global Advisors. My name is Brett Pattison. I'm a portfolio manager and investment advisor here at IronGate Global, and I appreciate the time that you are spending to listen to this short video that will enable you to learn more about the markets around you, become more educated, and understand IronGate Global's approach to managing portfolios. Understand that there's a lot of things that I cannot discuss in this video as it pertains to our portfolios. I can't tell you what stocks we're invested in. I can't tell you, and provide that information. That is for our clients. And if you are a client and would like to talk more about specific securities, feel free to give us a ring. You've got our number, you've got our email address. More than happy to have that conversation with you. Know that if you are not a client, we would love to talk to you. And I'll provide some contact information to you in a minute. But let's hit the agenda. What are we going to discuss today? And I'm real excited for the content that we have. We will, as we always do, talk about how the market performed. And I say global markets performed in May. How have we done year to date with the global markets and also sectors? And has it met our expectations? Are we doing the right things for our portfolios in regards to the global markets and sectors? All right, so we'll talk about that. Then we'll address the main topic at hand, which is a Chinese boomer burst. Now, for those that are familiar with the global markets, you know the Chinese market has been booming, and I'll show you what I mean. And a lot of people are calling for the bubble to burst here pretty quick. And so I pose the question, well, is it, or is it a potential opportunity? So we will hit that, and I will also provide a psychological checkup, which is addressing the month of June and whether it's the beginning of the end. And I want to prep you for some things that you're going to hear over the next month. And so those are the three things that we'll talk about today. Last time we talked about options and a few other things, which we won't get into. And I hope these videos are providing you some foundation as to how IronGate, again, manages portfolios and views the market, right? So let's recap May. Let's take a look at May. And I've got a picture here of a sunflower. And why a sunflower? And I put a sunflower because, number one, we're moving into June, right? And typically when the summer comes, you're going to see sunflowers. And why is that way? Well, because it just is, right? They bloom and sunflowers appear. And it happens the same time, maybe not the same week, but around the same time every year. Is weeds pop up, the grass is green, the flowers bloom, the sunflowers come up, right? And then the bees go and the cycle continues. And why I bring that up is important because the stock market's also very cyclical in the same way. And I will address that as throughout the next few minutes as to why I say it's very cyclical. And if you listen to the April video, you know what I'm referring to. But things happen in a similar way each year in regards to the stock market. So what do I mean by that? Let's take a look at the chart. Here's a chart since January of the S&P 500. And I'm just going to highlight a little section that encompasses May. So that's the month of May that you can see there. And I've got my little cursor I'm going to draw on. It's pretty little, so hopefully you can see that. But we started out May with a pretty nice boom, up day, and then we kind of we went sideways throughout. And we really, we finished the month, and we'll take a look at returns, but we finished the month slightly up. Slightly, 0.2%, and I'll show you the global returns here in a minute. 0.2%. The average return for May since 1950 is 0.1%. So it exceeded expectations. Not really. I mean, it was still pretty flat. And that's expected because that's what May does historically. So May didn't do anything, as far as we're concerned, didn't do anything that we didn't think it was going to do. And so we positioned portfolios to take advantage in terms of options especially. And the rest of the globe was in a similar pattern. The developed non-U.S. unchanged, down 0.91%, so down slightly. The emerging markets was the exception to this, and that's really based on China, which I'll bring up here in a moment. But those are the May global returns. With the emerging markets lagging behind the U.S. and the developed non-U.S. Right? When I say developed non-U.S. again, just for those that may be listening for the first time, that's developed Europe, that's Japan, that's Australia. That's those developed countries, right? The emerging markets would be the Chinas, the Indias, South Korea's in there, and those developing countries, those emerging countries, right? So as far as the 2015% returns, the U.S. is up 2.72%. The developed non-U.S. is killing it, up 9.53%. I say killing it compared to the other markets, right? Certainly there are stocks that we have in our clients' portfolios that have done better than 9.53%. But compared to the other global markets, it's killing it. And the emerging markets is still, despite a month where it was down 4.68%, it's still up 4.66% on the year. So the developed non-U.S. continues to do better than the rest of the globe, but everything's up, and that's what we like to see. That's what's best for everybody, right? Our clients, most importantly. So, how did the sectors do in the month of May? And then even before we get to sectors, again, back to the sunflower. We knew that May is typically a flat month, in regards to the U.S. markets especially, and it was. It did what we thought it was going to do, right? And if you've been listening to these videos, which hopefully you have, you know that that's the expectation. So as far as May and sectors, there's just a few sectors, and you can pause the video if you want to look at all of them, but there are a few sectors I want to highlight for the month of May, and that is healthcare. Healthcare had the best month out of all the sectors. The worst month was led by energy, which was just crushed, down 5%, right? A couple things about healthcare is, again, going back to the April video we recorded, that comes as no surprise. Healthcare typically does well this time of year, May through October. And we made an adjustment to the portfolios, and I'm speaking broadly, right? If you want more concrete information, more than happy to provide that to you. But we decided, based upon historical returns, we decided to underweight consumer discretionary, which we were overweight, and we decided to overweight healthcare and overweight consumer staples. So we reduced consumer discretionary, reduced industrials, and overweighted healthcare and consumer staples. And right now, that decision was the right one, right? Whether it will be going forward, we don't know. We just look at the historical and play the probabilities. But that's turned out to be the right decision for us right now. Now, looking at the year-to-date returns, healthcare is on fire, and we expect good things from healthcare. Clients know as they look at their portfolios, they'll see certain stocks in the healthcare world that we love in addition to the sector itself. The worst performing sector of the year, utilities, down 5.76%, which is pretty stinky. So there's where we are as far as sectors go, okay? And again, going back to probabilities, nothing really is a surprise. I think a couple things are actually a surprise. The fact that utilities are getting crushed as bad as it is a surprise. I'd also would like to see consumer staples doing a lot better than it's doing this time of year, but we'll take our overweight positions and be proud of what we've done, because it has been the right decisions, all right? So there's the May sector recap. So let's take a look at a couple things, and that is a Chinese boom. Let's address China, and I have a few charts I want to share with you. What you're looking at, the blue line, is an ETF called the iShares China ETF, right? It's an ETF, exchange-traded fund. And the yellow line is the S&P 500, just the S&P 500, index. You can see that year-to-date, and these are year-to-date returns, that China is up 18.57% through its ETF, the FXI, while the S&P is up 2.78%. Now, those types of returns are pretty darn good, anything, right? And this is China, and people get a little bit worried, they're not getting a little bit worried. They are worried. As China does a few things, monetary policy in China is kind of changing, and I'll explain to you a little bit more as to why and what they're doing. But let's take a closer look at the returns. This is back from April of 2014 to present. China, through that ETF, is up 37.44%, while the S&P 500 is 12.22%. So what the heck is going on with China? And is China going to burst? If you haven't heard those headlines, you will soon, right? China's done a few things. Let me explain to you what's happening to China. And I'm going to just focus on this chart for a second. Talk about that ETF, the FXI. The FXI is an ETF that it's not directly invested into Chinese stocks. You see, the problem has been for a long time that it's been hard for outside investors to invest in China because there was no real efficient way to do so. And so FXI was probably one of the easiest ways to go about it. And what that is it's Chinese companies traded on the Hong Kong exchange. Hong Kong directly, into China. So you have to go through Hong Kong to go to China. And so you'd buy these shares of stock of Chinese companies that are trading on the Hong Kong exchange to get, they're known as H shares, to get allocated towards China. If you want those types of returns, 37.44%, then you would have to invest through Hong Kong, right? Through what's called an ETF through ADR. And I'm not going to get into the complexities, but just know you're trading on a Hong Kong exchange. So the issue has been, for many, many years, how can investors invest directly in China, right? And that's where we're starting to see some changes. That's what's in large part causing this so-called bubble to form, is that for the first time, China is allowing outside money to flow into the country. And this is nothing, I think back in March we talked about this at great extent on this video, on this same type of video. But that's what's happening. And so you've got this potential bubble forming in China. And I'm going to pause there for a moment. So the question again being, is China going to burst? Is that bubble going to burst? And it's important for some of our clients who may have exposure to China. Okay? And for those that don't, this is not a recommendation that I'm going to share with you. Know the risks, know the volatility of emerging markets, but also recognize the reward as well. So let's talk about China in the World Index. And I want to introduce something to you. It's an organization called the MSCI. And the MSCI is a benchmarking company. Call it a benchmarking company. What I mean by that, and here's from their own website. I took this picture from their own website. A benchmark, just so that before we hit all those little graphics and things, a benchmark is something like the S&P 500. It's like the all-world country index, which we benchmark some of our clients to, right? It's something that you compare yourself to. And so the MSCI builds these benchmarks and has since the late 60s. And if you look at that chart from left to right, $9.5 trillion in assets are benchmarked to the MSCI indexes. Those indexes include emerging market indexes, global, the developed non-U.S. Indexes, global indexes, U.S.-based indexes, a lot of different indexes. 98 of a top 100 global investment managers are clients of the firm, right, of MSCI, and I hope this isn't coming across as a sales pitch. But 675 ETFs are built on the MSCI indexes. The All-World Country Index, which, again, a lot of our clients are benchmarked to, the ACWI is the ticker symbol, is benchmarked to one of the MSCI indexes, right? And so, very big company, and you can see there that 95% of U.S. pension funds and assets are benchmarked to the MSCI. So a big, huge firm that carries a lot of weight. Their decisions carry a ton of weight. And you'll understand what China has to do with this in a second. All right. When MSCI makes a change to any benchmark, it's a huge deal, as you can imagine, with $9.5 trillion in assets being benchmarked to what they do. Huge firm, huge decisions that they make and how they benchmark the different indexes. All right. So what does that have to do with China? Let's take a look at this. This is just a little table. It tells you the stock market, the size in trillions of dollars, and percent of the world as far as the allocation in dollars, right? So here you have the United States, $24.8 trillion, and the percentage of the world is 34.7%. China, $8 trillion, 11.1%. It's the second biggest, call it market in the world. Japan, third, $5 trillion, 7%. United Kingdom on down the line to France. All right, so just pure size and scope, $8 trillion in China, the size of their stock market, 11.1% of the world, right? Here's the problem. Here is the MSCI World Index. This is how it's currently constructed. The United States makes up 50% of that index. And the ticker symbol for this, if you want to look it up on your own, would be ACWI. Japan is 7.8, United Kingdom 7.1, France 3.5, and then China comes in at 2.7. So currently China, which is the second biggest market in the world in terms of dollars, is the last, at least in this list of countries, making up 2.7% of an index where it should arguably be 11.1. So you can see the situation at hand. Here you got the second biggest market in the world that is not, as far as the MSCI concerned, it's not allocated that way in their benchmarks, right, in their indexes. And so here's what's happening right now. And the reason I bring this up, on June 9th, which is just in 8 days from now, the MSCI is actually going to make a decision. Should we up the Chinese exposure in our indexes? That's the decision they're going to make. And they're going to weigh a lot of things. A lot of pros, a lot of cons. A lot of people will argue that no, the Chinese market maybe isn't there's not enough clarity. We don't know if the reports we're getting are real or not. Some people may argue, well, it's hard to invest in China, and that's probably the main argument. It's been hard to invest in Chinese companies. Well, as mentioned before, China's been making it easier and easier. They opened up what is it called? The Shanghai Hong Kong Connect, which allows people to invest directly into Chinese companies and buy local Chinese companies through the Chinese stock market. They're going to come out with later this year the Shenzhen, if I'm saying that right, Hong Kong Connect, which will make it even that much easier. So China has really been making a lot of decisions to allow people to invest more in their country, and that's what's, again, causing that bubble. Well, here's the thing. With all of this said, MSCI on June 9th will be making the decision. Because of the strides that China has made, shall we now up the allocation of our indexes to appropriately account for China's true size, right? It's the second biggest market in the world. Economy in the world. Should we change the allocation? If they do, look at the graphic up at the top. $9.5 trillion tied to these indexes. If they decide, let's take China from 2.7 to 7%, even 5%. If it's 11%, that'd be outrageous. But let's say 5%. If we double it and go 5%, then think about what all these asset managers around the globe are going to be forced to do. They will be forced to reconstruct ETFs, their benchmarks, investments, pension fund. All these people will have to adjust and will have to buy more Chinese shares to just to match a benchmark that MSCI creates. So huge decision. In fact, hundreds of billions of dollars are riding on this June 9th decision. So what do we expect at Iron Gate Global? I think our expectation is MSCI will, they're not political. They just make decisions based on the economy and the markets around them. So I think that they will be forced at some point to raise the allocation to China. They have to, right? Especially as China makes it easier and easier to invest in their country. They won't do it overnight. They won't come out on June 9th and say, yep, let's up it. Because that would cause such a mass, billions and billions of dollars overnight that it would move markets, but it would be total chaos, causing the bubble to just go, the supposed bubble, just to go crazy, right? And so you'll probably see MSCI, you'll probably say, hear them make statements as to, okay, we've gone through the first step. China does, 2 or 3 other things, then we'll make the changes to the indexes or put criteria together that China has to meet just as a way to delay it. And so what you could potentially, if MSCI does do it and does begin the process, you'll see a ton of money move into China. Whereas the thought in the market right now is that China's in a bubble. Maybe it's not so much in a bubble, right? So that's the opportunity, and that's what you're going to be hearing about in the news. And that doesn't mean go out and buy China, but that means keep your eye on things if you're an educated investor and see what happens, see how this plays out. This is something that doesn't occur every day, certainly. Especially when you're talking hundreds of billions and billions and $1 trillion+ potentially at stake here. So watch that over the next month. Certainly we'll be blogging about it on our website and watching that opportunity. But pretty market, a lot of big market decisions going to be made in the month of June. Now, that takes us to the month of June. And psychological check right now, right? June, is it the beginning of the end? Because I'm going to tell you what, you're going to hear a couple things about June as a whole. You're going to hear typically June's down 0.01%. Typically it's down, flat and down. So you're going to see some headlines when the market turns negative in June. You're going to hear people calling the end of the bubble, or not the end of the bubble, the end of the bull market. You're going to hear a lot of news on the Fed and the interest rate decision as there's a meeting in June, right? You're going to hear all this news. What we would like you to do is ignore it. Know what's happening, but don't take and make dumb decisions based upon 1 month's time. If you're nervous and you're a client, give us a call. If you're nervous and you're not a client and you still want to talk, let's talk, right? Email me, Brett@IGGA.com. More than happy to have that discussion. But because we're in that May through, again, going back to what we talked about last month, because we're in that on the far right type side of this table, because we're in that May to October time frame where the market is typically unchanged or up slightly, you may get nervous, but don't make decisions that based on 1 month or 6 months. You make decisions that are part of your game plan to build wealth over time. That's the importance of it. All right. Now we will be selling options to take advantage of that weakness. Talked about that last month. Not going to get into it now, so we will be doing that. Remember history so you don't make mistakes. All right. Now, moving forward, here's what we discussed. We talked about May and year-to-date returns. We talked about Chinese boomer bust. Keep your eye on that. It's going to be very interesting if you're interested in the markets at all. And then we talked about June and just relax. How's that for you? Relax. call us if you have any questions, comments, concerns. All right. Just another reminder, check out our education center on our website, IGGA.com. Also, there's my contact information. If you want to give me a ring, feel free. You want to give me, pop me an email, have any questions, Brett@IGGA.com, Brett@IGGA.com. My Twitter handle, LinkedIn, of course, if you want to like us on Facebook. We put a lot of cool little videos and pictures of life in the office, so to speak, on Facebook, so we'd love to see you there. With that, thanks everybody for joining in for this market commentary. Have a great month of June, whatever you do, and reach out if you have any questions. Talk to you soon. Thanks. Bye.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.